Recently, one of the leaders of Supermicro was asked where he sees the company's revenue in 2030, and he predicted that revenue will be over 100 billion by then. So let's see how they can get there and what that would mean for the company. If we look back at 25, their shares have been on a roller coaster. At one point, Supermicro erased close to 50% in market cap in less than 60 days. And the share price moved from around $29 or $30 up to 60 several times last year. Supermicro is your typical AI infrastructure play and one of the beneficiaries of the AI data center build-out. The tailwind is significant and investments are growing rapidly. The 4 hyperscalers now expect combined spending of close to 700 billion. This is 60% more than what they have spent last year. So there's a significant tailwind for the company. And you can see it in the numbers. They have multiplied their revenue over the last couple of years. Last year, they have delivered 22 billion and they are predicting a significant increase this year as well. Their business year runs till the 30th of June, so it is not following the calendar year. You have to keep that in mind. They have started the year by guiding for a revenue of 33 billion in 26. Then they raised that guidance after the first quarter to 36 billion, and now their target is at least 40 billion in revenue. If they can deliver on that, they will increase their revenue by at least 82% over 2025. But that is still less than half of the 100 billion plus what they believe is possible for 2030. So let's see how they could get there. To get from 40 billion to over 100 billion, they would need to increase their revenue by at least 26% every year to get to that number. There are so many challenges to get there. When their base was lower, it was easier to scale production, deployment and so on. But with a business of their size, it is getting increasingly difficult to keep up and scale revenue at 25% plus. If we go back and look at the numbers from 2021, they always have delivered that revenue growth. Over the last couple of years, they were increasing their revenue by 50%-ish. And from 23 to 24, they have even doubled their revenue. So from a low revenue base, they made it look easy to grow this fast. If we look at the infrastructure and production, they are expanding them fast to keep up with demand. They have a global manufacturing footprint with campuses in Malaysia, Taiwan, the Netherlands, and the US as well. One of the most important pieces that supports that growth from an output perspective is their site in San Jose. Back in 2024, they bought the former site of the Fry's Electronics store. This site has a potential for 3 million square foot, but they are building it out in several phases. The first building is under construction, which is around 330,000 square foot. Beyond the California campus, they are also looking to build a factory in Texas and the Middle East as well. The Middle East campus is going to be important to serve the sovereign customers in the coming years. So from a supply side, they are ramping up production to meet increasing demand. And the demand is coming mostly from the hyperscalers for now. At least, if you look at the numbers, last quarter, customer concentration was significant. They had one customer that generated over 60% of the entire revenue. This is up significantly from around 30% last year. But if we look at the last 6 months, the picture is the same. Revenue from their largest customer increased from around 21% to over 45%. This could be a problem down the line. Looking forward, they would like to broaden their customer base. This should also support their margins. Beyond the hyperscalers, it is enterprise customers which could help diversify revenue over the next couple of years. This is important because hyperscalers usually only want the racks, and that comes with low margins. You can see that in the numbers. Big revenue plus customer concentration with one huge customer equals low margin profile. Margins came down all the way from 18.8% to 6.4%. So basically, as the revenue increased, the margins got eroded. And one of the main reasons is that with these huge customers and orders, they have no or very little pricing power. But serving enterprise customers could help them with their margins, because these customers need more services and more support. That is why their DCBBS solutions are so important going forward. Right now, they have a portfolio of over 10 products, and they will add more over the coming month. These products come with margins that are over 20%, so it could have a significant impact on their margin profile in the coming years. Last quarter, DCBBS products contributed only 4% to their overall profit, but Charles Liang believes that this will increase significantly over the next couple of quarters. So we should see a positive impact over the next year or so. And this would be important because their margins are just non-existent. And when it comes to the critics, it is all about the margins. If they could significantly increase the share of the DCBBS range over the coming years, it could transform the company's margin profile. That shift would put the company in a very different place strategically and financially as well. For example, let's assume that they get to a revenue of 100 billion. With their current margin, that would get them to around 6.4 billion. But if they could increase it to a blended 10%, you are at already 10 billion. And then again, if they can lift it up to 15%, then they could generate 15 billion in gross margins and so on. I don't know how feasible that is, but I feel that they have to be able to do better than 6.4%, even at a much larger scale. Especially once production is up and running and efficiencies kick in. But it is true that past evidence shows the opposite, because as their revenue grew, their margins just collapsed. And growing revenue by sacrificing most of their margins makes little sense. And the truth might be somewhere in between. Anyways, if you look at the big picture and believe that they can deliver 100 billion in revenue, that changes the narrative. If they can also expand their margins, the story becomes even more compelling. A significant increase in revenue and better customer and product mix could get the company on a better footing. What do you think? Do you believe that they can broaden their customer base and move away from simply supplying racks to higher value services? Let me know in the comments below. Thanks for watching, and please give it a like, subscribe, and watch another video. See you in the next one. Thank you. Bye.